Welcome to the chase. You know, we're all running this race. We're all trying to claim victory in it. In my job, I get to sit down with wealthy people all week long. I hear about their wins, I hear about their losses, and quite frankly, like a bartender, I hear about their heartache. And I don't want you to run that type of race, or at least I want you to succeed at the race that you're running, and I want you to succeed at something that matters. Think about it like this. All the while you're chasing after something that's good, God's chasing you with something great.
Welcome to the chase. I'm Chris McAlpin, your host. And for those of you who are watching, you got a different look going on these days. Our good buddy and in-house producer, cameraman, and all things tech geek, Josh Taffer, is out for a couple of weeks. His awesome wife just had their third child, and so he's taking a break. I'm not really sure about his commitment these days. I'm really worried he's not in the studio with me. I'm going to question a few things with him because we've already had some technical difficulties this morning. I forgot to turn an on-off switch on. It's kind of funny how those things happen. But in all seriousness, congratulations to the Taffer family. We wish them the best. They're praying for their new wonderful child. Would want her to grow to be a good, godly, joyful adult. Because wow, the world needs more of those these days, right? So our good friend Jay Coulter is producing everything while Josh takes a break. And when Josh gets back, we're going to set up an entire new setup in the studio. I got all this equipment hanging around here, and I don't have a clue what to do with any of it. So this week, I have Clint Sorenson joining me. Clint is the founder and chief investment officer of Wealth Shield. He is highly educated with an alphabet soup of designations behind his name. He's a husband and a father of a wonderful family, snowboarder, MMA fighter, and all-around good dude. And so my good buddy Clint's going to be jumping on the show with us. There he is.
Hey, Chris. And you oversold me on the MMA fighter. I used to train, but these guys are a lot better than me.
But it sounds so cool.
It sounds cool, but
I
don't want people picking me up on the street and trying to fight me.
Trying to fight you. That's right. It's okay. He trained as an MMA fighter.
That's right. A lot better.
There you go. But you're an all-around hard-charging guy, man.
Yeah, absolutely.
You sleep like what, 4 hours a night?
Yeah, if that. Depends on the night. So I
sleep
on the
great.
Night. Yeah, it's quantity. Quality over quantity.
Quality over quantity.
That's right.
All right. So it's because you're so focused on stuff. So this is my fun fact, right? So give me a fun fact. What's the most interesting book you've read this year?
Most interesting book I've read this year was probably Meditations, which I always pour back into, by Marcus Aurelius. So it's obviously a book on Stoicism, but it is incredible. Just a glimpse into history. And so I always tend to get back to that book. But yeah, that's probably it.
That is deep, dude.
Yeah, man.
Meditations by Marcus Aurelius.
Yeah.
Okay. All right. So for everybody who's wondering, Marcus Aurelius was the Caesar at the beginning of the movie Gladiator, not at the end. Right? That's who he's talking to at the beginning of the movie Gladiator. Now, Marcus Aurelius was a real guy in history. He was a Roman Caesar.
Yeah, he was calm, collect, the stoicism. He was a man of the people, and it's interesting because I got turned on to the book by Ryan Holiday, who wrote Ego is the Enemy, some other greats, right, that I really enjoy. And that was how it was on his reading list, and obviously something that he had talked about as he has gone down his stoicism journey and wrote about this a lot. And that's how I got onto it, and I've loved it. So that's been a fantastic read for me.
All right. So I'm going to have to read that and compare it to, say, Ecclesiastes, the philosophy book in the Bible.
Yeah.
So here we go. You ready? Lightning fast rounds.
Let's roll.
Since you're one of the best investment minds I know that can communicate what's in your head in a way people can understand, we're going to warm up with current events, current economics before we move on to market predictions and geopolitics.
Okay.
All right. So here we go. You were fond of saying, if you get the business cycle right, you get the market cycle right. So where are we in the current business cycle?
Yeah, no, that's a great question. And I think that's the most important question, right? And then you won't hear the media asking that question because then they lose the narrative machine. They don't have anything to argue about or talk about. But that's really, as simple as we should make this is where are we observing data? Where are we in the business cycle? And the way I look at that is growth accelerating or decelerating? And we can look at leading economic indicators to keep it extremely simple. And then is inflation accelerating or decelerating? And we can look at commodity prices to keep it extremely simple. And what we see is that we're an economy that's still growing above trend, right? In both growth and inflation, but we are in fact slowing. So it's like a car driving 100 miles an hour that's not now driving 80 when you're speaking of inflation and 50 when you're speaking of growth. So that's precisely where we're at. And so what we classify that at is a slowdown. So you really have four different phases of the business cycle. You have a recovery where growth is moving up, but you're below trend. You have an expansion where growth is moving up, but you're above trend. You have a slowdown where growth is now moving down, but you're above trend. And you have a contraction where growth is moving down and you're below trend. So those four phases, the most obvious phase that we're in currently and have been in for about a month now is the slowdown phase. So above trend growth, but slowing.
Okay, so it is above the line, so we're positive. It's just slowing down. So what does that tell us about the markets?
Yeah, so it tells us that you want to shift up quality. So if you look historically, and again, this is why I love observing the business cycle, because it really gives us a scientific method approach to markets, right? Because we're observing, asking questions, we formulate hypotheses, we test those hypotheses based on historical information, and then we're able to use that to assess the probabilities of how a portfolio could potentially perform given the environment, right? It's a great way to kind of look at that. And so when we look historically at these different business cycle environments and we break them into factors. So think of factors as value as a factor. You can apply this across asset classes, but value, size, which would be small cap versus large cap, quality, so higher quality companies, higher quality balance sheets versus lower quality, and then momentum, which would be the companies that are doing well continuing to do well from a performance perspective, or issues, right? If you're thinking about bonds or other issues, and then lastly, low volatility, so things that are lower volatility than, say, the peer group or the environment. So if you break it down into factors and just those factors, what you'll find is that in a slowdown, it's one of the few, there's only two regime shifts that have major implications in terms of what factors to rotate to. And when you're in an expansion, size and momentum and value tend to work the best. So at the beginning of the year, as we went from recovery to expansion, you saw those factors really play out. Everybody rotated to value, energy got a boost. You got the move into small caps. When we started rotating into the slowdown, it's a profound difference from a factor exposure. So what started happening is you saw a rotation into high quality. You saw a rotation into low volatility. And so we've seen that over the last 3 to 6 months. For instance, low volatility equities are outperforming high beta equities, so higher risk equities over a 3 and a 6 month period. And we've seen growth now outperform value, back to outperforming value on a 1, 3, and 6 month period. And so you're seeing this, and now high quality is one of the top factor exposures. So that's where you want to be in a slowdown across asset classes. You want to start focusing your exposures into high quality exposures, because when you couple the business cycle with where we are from a valuation perspective, you have a high probability of shocks. And so it makes sense to have quality in the event of a slowdown. So that's really sorry for the long-winded answer, but that's really where you want to be.
So let's take this to when I say the average investor, most of our listeners, the retail investor, those of us that are putting money in our IRAs, our retirement accounts of all sorts, our investment accounts to pay for college, things of that nature. So most people are watching the S&P, the Dow, the NASDAQ. What do you expect investors to see? What should investors expect to see as they look at those major indexes?
Yeah, so I think what we have seen in the S&P over the last, call it 2 months, right? That's exactly what you see in this rotation. And it's because of how the S&P is now composed, right, or built. It is essentially 5 names. Those 5 names are high quality, of the highest quality when you look at balance sheet strength, and they're mega cap names. So, you're getting more of that large exposure. So what we saw happening is interest rates peak in March, kind of cluing us in that this whole growth and inflation explosion that we got, right, on the recovery was going to peak out in Q2, which it in fact did, especially if you look at leading economic indicators. You had the Economic Cycle Research Institute's weekly leading economic index was up over 20% according to their growth rate calculation. It's now at 4, right? So it went from
isn't that coming off of last year where we have these hyper growth and messed up numbers from COVID, from the shutdown portion of COVID?
That's right. Base effects have a play, right? They have a play. So that slowdown, what you would expect is that, the market will bypass that because it's still going to discount growth. But what happened is you had a rotation into these mega cap tech names. So we saw a clear deterioration in market internals where the percentage of stocks in the S&P that were above the 200-day moving average, so just to measure a trend, had deteriorated along with interest rates falling, right? But the index continued to make all-time highs each and every week. And when you look at that, that's exactly what should happen on a rotation to quality. And so that's what has happened is you had this rotation back into quality and a rotation back into growth and a rotation back into mega cap. And that's the first sign that we're getting that rotation, right?
Okay. So do we expect it to keep going up?
No, not necessarily. So that was the first thing you expect. Now, what you have to start looking at now is the susceptibility to risk and to shocks. And when you look at the susceptibility to shocks, we're high. Market internals have deteriorated. We are at all-time high valuations. If you look at anything that's shown historical accuracy, right? So the Fed, through their policies, has probably condensed the business cycle. At least that's what I think, opinion moment. But they've extended the valuation cycle. So valuation cycle, where mean reversion, right, which takes high values, moves them to low, used to take 7 years.
Define mean reversion for us. Define mean reversion. And everybody forgot what that meant in math class, okay? They took a test and they forgot it. So mean reversion means what?
Means that, so if you think about what mean reversion means, it says when the mean is the average. Think about that as fair value. So the average value of the S&P, I'll pick on the S&P for a moment. We are so high above that. We're 180%, according to the line of best fit, above fair value, right? So 180% above that mean. Reversion to the mean suggests that will eventually come down. Now, historically, that's taken about 7 years to happen. Now, the opposite's true too. You get below it, right? You move back up to the average.
So what you're saying is, let's make the numbers up. Let's just make it easy. Say that the historical average is worth $1.
Mm-hmm.
And right now we're at $1.80.
That's right.
And one of two things is that historical average, that $1 historical fair market value either has to come up to $1.80, or $1.80 has to come down to $1.
That's right.
Right. So math being what it is, probably going to meet somewhere, not necessarily in the middle, but the mean's going to rise a little bit. We may go to $1, $1.10, $1.15, and that 180 come down.
Yeah.
But either way, you're saying that eventually in the major indexes, it has to come down.
That's right.
Right. Now, then let me ask you this question. Let's do something that's very untrend follower like, which is what you are. It's very against your nature. Give me a prediction for next year.
I will not do that, right? I've got to look at the trends and say, hey, well, the trend's still up. Trend's still your friend. So if I'm looking at international equities, right, the trend's down. You're seeing some significant deterioration there. So the trend's down in especially like large cap China. So you got to say that they continue down. In the U.S., you got to say they continue up, right? What's strong will continue to be strong in trend follower language. And to borrow a quote from Paul Samuelson, as the facts change, I'll change my mind. So
okay. So if I were a better interviewer, I would keep asking you the same question 5 different ways. But I know you well enough that I'm not going to get a better answer.
Nope.
And our compliance team wouldn't let either you or I publish this show if you did.
I'll give you the best answer. See, anybody who's giving you price targets and this nonsense based on PE multiples it's just complete nonsense. But I'll tell you.
So you're saying that when somebody's calling a number, so as we go into the fourth quarter, the favorite thing to do in our industry, people start calling an S&P number that it's typically nonsense.
It's complete nonsense. So I'll tell you
I agree
the
with
prediction is the best prediction I've ever heard, and it comes from JP Morgan. And somebody asked him what markets will do next year, and he said markets will fluctuate. So that's my answer. Yeah.
All right. So we've got a lot of money sloshing around in the markets with the Fed. That's why it's kind of hard to hold on to that risk. It's hard to stomach managing risk at times like this, Clint.
Oh yeah.
It's hard not to buy the big names and let them run.
Yep.
Why don't we just do that?
Because of mean reversion, because of how far we are from fair value in some of these names and the broader indices, and because we know historically speaking that expected returns should be negative for the S&P 500. If you bought looking at just the Buffett indicator, market cap to GDP, and Dr. John Hussman uses non-financial market cap to GVA, gross value add. GDP is gross domestic product. So very similar. When you're looking at those ratios, you are now priced for negative returns. Negative if you bought and held the S&P from now going forward for 10 to 12 years. Now that everybody's like, okay, well, this time's different. Well, the problem is historically going back to 1928, it's always worked out that way, right? Sure. The average return has matched out, and it has been matched what the expected returns were, and it has done it with amazing accuracy.
I think this is where people struggle with this, Clint, though. They struggle with industry guys like you and me when we're looking at these data and we're looking at these facts and the indexes, because when people say the market's going up, they're talking about the Dow, they're talking about the S&P. It just depends on who's asking the question.
Right.
But you and I know that's not the broad market. That's not all there is to the market. But they hear us talk about data and that the Buffett indicator, the PE ratios, whatever figure we're using, and it's all overvalued. It's all overvalued, and it's going to crash. It's like Chicken Little. The sky's falling, all the time. So why does it matter to keep managing risk in an environment where the Fed has pushed so much money into the markets?
Because they can't prevent it from happening. They've always pushed money into markets. There's always been open market operations. There were open market operations. The plunge protection team was in full effect in 2000 when the NASDAQ peaked and went down 83%. And now the S&P 500 is above where we were at that period in time. So the S&P 500 is actually at a point where it's so much more overvalued than where we were in the NASDAQ bubble that it makes that look cheap. So, and they couldn't rescue the markets then, right? What's happened now is all they can do is extend and pretend. They actually cannot do anything at the end of the day to stop this from occurring. So they can just delay it. That's why I mentioned earlier, they've probably extended the valuation cycle, in my opinion. But at the end of the day, the average returns will match up. They are squeezing return out of everything. Now, I'm not saying there's going to be a crash. That's not what I'm saying. I'm saying we're susceptible to those type of catalysts, right? We're susceptible to these things happening, and it doesn't mean that they will, right? But we have to be prepared, and we have to build resilient portfolios, and we have to have diversification of systems, diversification of exposures. We have to stack opportunities. We can't just buy and hold the S&P. And I'm actually very scared because we've had this proliferation of investment into index funds, considering them to be passive and low cost, where it's drawn a lot of people in because they've done so well. Well, the problem is now you're really buying 5 names, and you're buying 5 names at a point where the S&P 500 is the most overvalued it's ever been in history and most susceptible to risk. And there's no risk. There's no process to that. You're just buying the highest market cap names. And that scares me for people. So
sure.
I think
and this is part of our show that we have talked about this. And as we teach biblical financial planning, that there's actually a lot to talk about from the Bible when it comes to investments. There's a lot to talk about from the Bible when it comes to financial planning. But most often, looking at what 95% of the world is doing and doing the opposite can be a good idea. And you're just, just do it different what everybody else is doing. But that doesn't give a specific answer. So what I want you to do, you be an advisor, and let's obviously from a compliance standpoint, we're not giving investment advice right now. Let's be clear for any listener, we're not giving investment advice. But based on these ultra high valuations, maybe we're growing out of COVID. Maybe we're not growing out of COVID. We've got all this weird stuff going on, even as we record this, debt ceiling debates, China fiasco. Gosh, look on the current news cycle and pick another topic, right? What do you say to the end user investor? What should they be looking at, thinking about, and doing?
Yeah. So first thing is you've got to have a process, right? Period. Got to have a process. It's not emotional. It's rules based. It's based on historical markets, what they've done, where you can assess probabilities based on that information, and then again make decisions that have at least some sort of guidance to them, right? In a process, and really defend you against your own emotional bias. I have to do that as a professional. So that is first rule. Second is you have to look at valuations and you have to say, okay, where are the best opportunities long term? And I want to have the flexibility and the ability to overweight those opportunity sets long term. Not saying I'm going to jump in them now, but I need to have a process for doing that eventually. So those are in public markets right now, it's global over domestic. So think emerging markets, China with all the pain now, getting pretty attractive from a valuation perspective. Not saying there won't be more pain, but they're getting attractive. Small caps over large caps, value over growth. Those are three areas in the public markets that make a lot of sense. And so figuring out how to make sure that I can allocate to those areas when the trend is in favor, which is the next part of the process, would be what I'd want to do. And the trend just says, hey, when the market is voting and telling me that those areas that I want to be weighted in, that I'm right in that estimation, right? That the market's waking up to the value opportunities there. I want to make sure I have a mechanism for getting in those positions. And then lastly, I want to have a risk management plan. So I want to be able to make sure that I have a diversification of systems within my portfolio. Now, one of the best ways, in my opinion, to do that is by adding just simple trend following rules to anything, right? If I buy the S&P 500 in one account, and then I buy the S&P 500 on our trend system, it's called the 200-day moving average. Every month I look at it. If it's below it, I'm out. If it's above it, I'm in, right? That means the S&P above the S&P, the 200-day, or below its 200-day moving average. If I did that every single month, the return and risk characteristics are going to look completely different. So I've taken stocks, I'm allocating the stocks, but I've made them perform differently. And that cuts, what that's doing, or what trend following has done historically, has been cutting off the major risk events. So preventing the really long drawdowns, the big bear markets, and it allows you, at least historically, has allowed you to live to fight another day. And that's because if you lose 50%, we all know you have to gain 100% to get back to even. And even worse, and we've had this happen several times in market history, if you lose 75% or more, you have to gain upwards of 300% to get back to even. So cutting off those huge drawdowns means a lot. So again, first part of the system, have them, or there's really four parts. First, have a process. Here's a process that I think is simple to use. Number one, look at value, figure out where the areas of opportunity are based on historically accurate valuation metrics, and make sure you have a process for getting in those areas, or having the capability to get in those areas. And then use the market trend, measures of strength and weakness to determine when you go in there. So you have the what defined by valuations, and you have the when defined by trend. And that's it. And then the last part is have a risk management plan. Make sure you are diversified. You're not putting all your eggs in one basket. And I'm not talking about just diversified between stocks, bonds, whatever. I'm talking diversification of system, right? Have an ability to capture the business cycle in one system. Have the ability to have trend following added to your portfolio so that you have risk management. There's so many different systems you can employ that create a more resilient portfolio than just buying and holding something that is as highly valued as it is today.
And I think people forget this, Clint. We have such short memories. In 2000, everybody was saying it was different this time. The technology revolution had changed markets, which that was a true statement, just not in the way people meant it back then. And that the markets were going to continue to go up. And then the new version of plunge protection team of QE after 08 and 09. And certainly you and I have looked at the data. It has changed some characteristics in the market, some behavior that we have to research and that we have to test for. But to say that a market that is extremely above valuations and that it's different this time. It's not going to come back down. You have 400 years worth of data, at least that I know of, going back to the 1630s and the tulip bubble, of bubbles demonstrating that they burst. And that's a different topic for a different day. We'll dive into that. But you know what excites me in what we're seeing is that data behaving, giving us the results that it should give us. And it does allow us to build portfolios for clients that can help them successfully get to their goals. And I think that's one of the biggest detriments that I see with people in the markets. They are keeping score. I got to make this much money because my buddy on the golf course is making this much money. When the truth is, they need to have a risk characteristic and a system built to help them reach their financial goals. Everything else is just keeping score. Why are you doing that? That makes money your master, and it's an insidious master. But again, that's also a different topic for another day. My friend, I appreciate you being on the show with me. You'll have to come back. We're going to make this a regular thing so that we can give everyone quarterly updates, at least, if not more often than that.
Yeah, Chris, I'll say one more thing to part is, this is now, in my opinion, the time for people to have a financial advisor and to have counsel, because it isn't going to be as easy as it was the last 10 years when the Fed's balance sheet went from 800 billion to 8 trillion, right? And lifted everything. It's going to be more difficult. It's going to be possible, but it's going to be more difficult. And so it's a time for skill. It's a time for finding a great financial partner and advisor to help you. It is time. I have a financial advisor. So, I mean, I'm a money manager.
And you do this for a living.
That's exactly right. I think it now is the most important time. And I love it for professionals in our industry, because I think it's one of the best times to be an advisor ever. And I think it is the best time to hire an advisor.
Super. Ladies and gentlemen, Clint Sorenson. Thank you, my friend.
Thank you.
We are so glad that you took a few moments today to sit around God's blessings that He is chasing after you. If you enjoyed today's message, I hope that you share it with your friends, your family members, small group, business partners, and if you haven't already, you need to go ahead and subscribe so you don't miss anything in the future. If you give us your email today at the website listed here, that's, for those of y'all listening, that's soundfsg.com/The Chase. We're going to provide you exclusive access to our resource page, The Chase Podcast. On it, we're going to have helpful information about investing. We're going to talk about faith-based investing and how it compares to the S&P 500 and other exclusive content just for you.
For disclosure and citation information, please go to www.soundfsg.com/disclosures.